Hi everyone, welcome to practice problem BS-10. This one is all about analyzing the assets on your balance sheet. So it's just one problem, but it asks you for three different answers. It tells you that Flyer Inc.'s accounting system shows the below information related to assets and income for both 2018 and 2019. The three things you are to do is determine the asset turnover ratio and the return on assets for 2019, that's 1 and 2. And if the asset turnover for Flyer Inc.'s industry is 0.2 for a similar amount of assets, what do you learn about Flyer Inc.? And so that is number 3. Take a moment, see if you can do these calculations as well as that analysis on your own. When you're ready, come on back and I'll walk you through the solution. All right, welcome back. So in order to do ratios, the first thing we have to do is actually know how to calculate those ratios. Asset turnover ratio, what I'm going to abbreviate here as ATR, is net sales over net, or I shouldn't say net, I'll just say average, sorry. Average, I was going to say net assets, but typically you refer to assets as total assets. So average total assets. Now, if we think about the return on assets ratio, it is actually very similar. The only thing that changes is the numerator. In return on assets, it's net income over average total assets. So you see, if we solve for one, we'll have half of the info we need to solve for the other. The common element there is average total assets. And if you look at the information given, you were not actually given total assets, much less the average of your total assets. However, you were given a lot of information related to assets, and so it was a matter of figuring out for yourself what exactly are total assets in this case. And so cash is an asset, your buildings are assets, your inventory are assets, and accumulated depreciation, even though it is not an asset, it is a contra asset, and so that is actually going to reduce the value of our total assets. So if I pull out a calculator for this one, covering up there, let's do 2019 first. We've got $150,000 in cash. We've got $200,000 for the building. We've got $10,000 for the inventory, and then we have to subtract $50,000 for the accumulated depreciation. That gives us total assets for 2019 of $310,000. We do the same for 2018, $165,000 in cash, plus that still $200,000 building, plus $23,000 in inventory, minus in this case we only had $40,000 in accumulated depreciation then, so that gives us $348,000 in total assets. Now remember, we do need the average total assets for the year. We're trying to solve for 2019. So whatever you ended 2018 with, that's what you started 2019 with. So that's kind of your beginning total assets, and this is your ending total assets. So if we simply add the two together and divide by 2, that tells us that on average, we had $329,000 in total assets. And so for both equations, this is going to be our denominator. 329,000, 329,000. Now we need our numerators. For asset turnover ratio, we need net sales. Now we were given sales revenue, $95,000 for 2019. However, we were also told about some sales returns and allowances, and those sales and returns and allowances are a contra revenue that net with our sales revenue to give us net sales. So our net sales for 2019 is $95,000 minus $2,000 for a total of $93,000. Okay, and we can go ahead and work that ratio out. So 93,000 divided by 329,000 gives us an ATR of I guess we'll just go ahead and call that 0.28. We'll leave it there on the rounding. Okay. If I move on to ROA, what I need is net income, which was actually given to us here, net income. It was $45,000 for 2019, and so we're going to put $45,000 over 329. Let's go ahead and do that. 45,000 over 329,000, and that gives us 0.14. or 14%. Usually you think of ROA in terms of percentages, so we could say 14% return on assets. All right, so that gives us the hard numbers. Now, objectively, what is this telling us about the company? Well, it tells us, remember, assets are things that you are supposed to generate future value to the company with. Your sales is essentially how those future values come to fruition. So what this is telling us is that during the year, on average, we are only converting about 30% of our assets into sales, 0.28, 28% of our assets actually turned into recognized sales. Okay, if we look at ROA, return on assets, what is that telling us? Well, again, remember, assets are supposed to generate value for your company. And essentially what that's telling us is that for every dollar that we have in average assets, we are generating approximately 14 cents in bottom line profit, in net income. Okay, so that's what the two ratios tell us objectively. Our final question was, if the industry asset turnover is 0.2, then what does this tell us about this company? Well, what that says is that on average in your industry, you only turn about 20% of your assets into sales in any given year. And so since this company is converting almost 30% into sales in any given year, it is essentially saying that Flyer is more efficient at converting its assets into actual value. The asset turnover ratio is considered an efficiency ratio. How well do you turn this value generating thing into actual value? All right, that was it for this practice problem. I hope you found it helpful, and I hope you join me for another.